Welcome to the Nedgroup Investments Excess Guarded Fund of Fund Quarter 3 commentary. The Excess Guarded Fund of Fund sits in the low equity prudential category, which has a maximum equity allowance of 40%. It has a time horizon of 3 years or longer and is Regulation 28 compliant. Over the quarter, the fund was up 1.9% relative to the peer group average of 1.6%. The main contributors of the last quarter came firstly from our global equity holdings, where we saw rand weakness helping our offshore assets, and secondly came from our domestic fixed income and cash holdings that also achieved positive returns over the quarter, given our relatively high interest rates of around about 8.5% to 9%. Some of the detractors over the quarter came from the South African listed companies that are exposed mainly to the domestic economy. With our economy taking strain and in a technical recession, these companies were hit quite badly over the quarter. In addition to that, local property stocks have also performed poorly and struggled, given the risk of a slowing economy and possible interest rate hikes. Looking at the fund's performance over the various calendar years, we see that the fund has managed to perform strongly to peers over all time periods, barring 2017, when we slightly lagged. The fund has achieved a return of 7.1% per annum over the last 3 years, relative to the peer group that has achieved 6.0%. Over a 5-year period, we have achieved a return of 8.2% versus the peer groups of 6.8%, so again managing to outperform our peer group quite consistently. This has resulted in the fund being in the top quartile versus our peers. If we look at the risk measures within the fund, we see some interesting factors coming out. First of all, the fund has a volatility of just 4.1% versus the South African equity market at 14.6%. In terms of a maximum drawdown, the fund has had negative 4.2% versus the South African equity market that sits at a maximum drawdown of minus 40.4%. Over a rolling 3-year time period, the fund has 100% of the time outperformed the peer group. 77% of the monthly returns have been positive. If we look at the quarterly return distribution graph on the bottom right-hand side, we see that the vast majority of the time, the fund achieves a return somewhere between minus 2% and 3% per quarter, with by far the right-hand side of the graph or a positive skewness towards achieving positive quarterly returns somewhere between 1% and 3%. The following slide just sets out the performance of the fund versus the various classes that it is available in. One can just look at the relevant class to see the performance of your particular holdings. If we look at the asset allocation changes across the fund, you will notice just 2 main things where we have changed the asset allocation over the last quarter. In the one area, we have slightly reduced our global holdings, and you will notice that global equities, for example, has reduced from 16.4% down to 12.3%. During this quarter, when the rand was extremely weak at around about 15 rand 30 to the dollar, we decided to reduce some of our offshore exposure and brought the money back into the domestic markets. This is reflected by a slight increase in the domestic equity and domestic bond asset allocation figures that you can see relative to the past quarter. The funds are currently well diversified across all asset classes, and in addition to that, we hold a healthy cash allocation to take advantage of some timeous market opportunities. From an asset allocation perspective again, we can see that the fund has approximately 21.6% in direct foreign holdings and 9.7% in rand hedges. Rand hedges are defined as stocks that earn at least 50% of their revenue offshore. The fund thus has close to 33 or 34% in direct offshore exposure. The top 10 holdings are dominated by Naspers, Sasol, British American Tobacco, BHP and Richemont, all of which are large, well-known rand hedge stocks. Looking at our domestic and global asset class positioning, you will notice that the fund is relatively conservatively positioned, with us having neutral to slightly over or underweight asset allocation positions across the various asset classes. From a global equity perspective, we have slightly reduced our exposure and are sitting at close to neutral, while we are underweight global government bonds and overweight global cash. In the domestic markets, we are slightly overweight property and bonds, as well as sitting in overweight cash position and close to neutral on a domestic equity exposure. We have been slightly increasing our domestic equity exposure as we feel that the opportunities arise within the domestic markets, which have taken quite a lot of strain over the last 6 months or so as emerging markets have come under pressure. The final slide just sets out the various fund managers who we hold within the fund. You will see that we have exposure to some of the leading fund managers, both globally and domestically. One of the benefits of a multi-manager product is that you are able to get exposure to different styles and types of managers, each of whom will perform differently in various time periods. In addition, we mix both active and passive management, as we feel both has a role to play in the management of a fund. We hope that you find this report and commentary useful and beneficial. Thank you.